Welcome to Markets Now. I'm Michelle Rook along with John Payne with Hedge Point Global Markets. And we did see higher prices in the row crop sector, wheat, cotton lower, but the livestock sector ended to the plus side. And John, let's talk about soybeans, the price leader, putting late weather premium or late season weather premium into that market. How unusual is that?
Well, it's not. This is not a seasonal time of the year where you tend to see prices rally. That's for sure.
Right.
You look at the tight years of 2012, 2013. The market got discounted into this time of the year because of supply hitting the market. We're not seeing that this time. I think the main difference is crush margins. You have a crushing industry here in the U.S. now that is, due to a lot of other factors, is humming in regards to how it needs supply. The profit margins for crushers is well north of $1.50 to $2 a bushel, depending on where they're buying it. So as long as those hold in, you have plenty of room that beans can rally here to shut down those margins should they need to be shut down. And that would then follow. I think you see corn follow on a market like that. But in the short run here, I wouldn't be too carried away to jump long. I think you're more of a break buyer on that July contract because, again, the South Americans that we work with here, and we represent a lot of farmers, we see selling, and they don't really have anything else to do but sell and sit on hedges. So until they have problems and want to trade out of those hedges, I don't think you're going to see a huge runaway market here in the beans outside of the move up to 14.5 maybe. But to get above 15, I think you're going to see the oil and the meal markets move with it.
All right. And what about corn? Because corn seems to be more of a follower. Can corn continue to follow soybeans and get above that $5 mark? And how far do we run then?
Well, the corn dynamic's a little different just because you're talking about a front month contract that is so much cheaper than the next contract. So
Right.
This is a difficult kind of concept for a lot of people who don't trade futures and just look at price. But these futures contracts expire. And when they expire, you need to essentially, to play the board, you need to be in the next contract. Well, that next contract is more expensive. So to roll out of September and get into these futures today, it's going to cost you close to 15 cents. So that means if the market stays sideways, you could lose 15 cents just as the December meets the March or the September futures where they are now. Don't think that happens right away. I do think you'll see some premium get priced in the Ds, but I don't think a runaway market's going to happen until, as I mentioned on the beans, the South American weather problems have to develop because those are the big producers now selling the board. And as I mentioned, we have producers that just kind of sit on hedges here, and that's their insurance. So until they start to lift out and really rip out, I don't think you're going to see some upside volatile move. It's going to need to take a couple of weeks to go by and we get into that growing season, which really probably won't start until October, November.
So what's your thought about yield there? Are we, crop looks like it might be getting a little smaller. Pro Farmer came in with the 172 yield, and now USDA has a little work to do. So do you think that the market already has that programmed or priced in?
I do. I think the moves we've seen today have priced in a lot of the negativity that came from the tour. I just don't think there's a dynamic here you're going to see producers buy back. And that's really what gets markets moving. If you think the spring rallies we've seen, it's where the producers get hedged up and then they have to buy back hedges and creates kind of an exacerbated problem where the market goes up, folks don't have the grain to sell, they need to buy back the grain, which creates even more buy pressure. I think that was a good example of what we saw in the June run up here in the U.S. But again, for that to happen, I think you need to see some problems in South America. And unfortunately for corn, you don't really have any markets to trade out of because the big Brazilian plant will come after the soybeans. Now, I will say El Nino tends to be bearish for Argentinian prices, meaning they get good yields in Argentina in El Nino. Southern Brazil, which is where a lot of the winter corn or the early corn is planted, it's only about maybe a third of the early crop. But that would be what you want to watch here short term. So they'll start planting again late November or late October, early November, and then those weather problems will show up probably around the first of the year. So in the meantime, you have a carry market that is kind of being eaten up by high interest rates. And for the example is somebody would come to me and say, hey, I want to sell. Should I sell or hold? My initial reaction is to go to that March board and say, okay, well, where's March trading right now? 510, let's call it. We're at 477 on the SEP board. So you're going to hold supply right now off the SEP. That's a 30-cent give up that you're assuming prices are going to go up, and you have 6% interest rates, in a money market account that you would give up by not selling. So there's a lot of hurdles here. And I think that's why we've priced in such a move in the carry is that there's substantial reason to sell for the producer, not just tax avoidance or anything like that. It's truly sell it here because you're giving up opportunity costs, both the carry and the time value of interest rates. And that's, I think, a factor we really haven't seen in the last 15, 16 years.
Yeah. What about this wheat market? Was that more technical selling, John, or was this kind of some of those Black Sea headlines again?
Well, the wheat, the U.S. wheat can trade off the Black Sea and it can trade off what's going on in Europe. But in reality, the domestic markets here in the U.S. are well supplied, and we're in a VSR level, the variable storage rate. I could, give a 20-hour class on what variable storage rates and the result of that. But the short run is, we've got essentially triggers that are being hit on wheat where these storage rates are being locked in at 15 under or 10 cents per month. So that's 30 cents per delivery period. So as I mentioned in corn, owning corn is expensive given the interest costs. Owning wheat is even more expensive because you have a 30-cent spread between the SEP and the DEES contract, not to mention the price is higher. So you're giving up more revenue not to sell. So I think at this point, want to see what the U.S. producer plants next year. I think that'll be a nice, indicator of a need for a bottom, as well as what comes out of Canada. Short term on wheat, you watch the Russian offers. All right, when we have a tender, and they tend to happen almost every day, where you see, okay, somebody's buying wheat from the Middle East. What price are they paying? Pre-COVID, they were paying $180 a metric ton. That's all in. Post-COVID, they started to pay closer to $210, $220, $230. Then the war hits, they paid upwards of $400 a metric ton for wheat. Now we're back to $250. So close to $60, $70 above where it was pre-COVID, which, represents about $2. And I think that's fair value where we are right now, given that we were at, call it $4 wheat, $5 wheat before COVID. Now we're at $6, $7 wheat. So I think market's probably going to find a low here in the short run.
Yeah. But again, you say some of this wheat selling was tied to first notice day.
I think so, yeah. So if you are long the board, and I'm speaking to anybody in a futures contract, if you're long here, you have to be out by Wednesday's close or your assigned delivery. Now, that could be a good thing or a bad thing. If in the case of corn, nobody wants to deliver here, the price will go up. And I expect in delivery, when the speculators aren't around, you probably see set basis go up because you need to have, these guys need to supply themselves here. They've got a nice carry market to do it, and profit margins are good. This is the best price they've had in 3 years. So I think you're going to see an active buyer here.
And the cotton market seeing a little pressure here today, but are you a little more bullish longer term?
Longer term, I'm bullish cotton. I'm bullish cotton on the global economy. I think that the amount of stimulus that's being printed here, combined with the idea that just organically we have a strong consumer in the U.S., I think cotton prices should find a level here. Crop insurance prices are about 84 cents for the producers in West Texas. I do think you'll probably see that level again, just given the strong dollar. But all in all here, I think cotton's probably more of a sideways trades if we don't get any major tropical data. And then, look at what gets planted next year, because again, it's what's going in. That's really the story right now, Michelle. It's we can talk a lot about the front month stuff, but what's beans right now, July soybeans for next year. This is, you're getting huge numbers that are going to be harvested next spring for Brazil's soybeans. The market could be very well supplied by then, even with U.S. fundamentals tight in the short run. So it's a tough trade for beans because you could see it fall apart rather quickly, especially if Argentina gets going. That's the one news that, as you talk about this stuff every day, keep your eyes on Argentina. This election is a huge deal. They're a major producer that doesn't participate in the world markets right now to a degree because of their economy. And if that would change, markets like soybean oil would change drastically as Argentina bean oil prices are half of what they are here in the U.S. And I think you might see some arbitrage plays there where all of a sudden Argentina's taking market share. Now, they need to elect this guy to have that happen because right now, the way their government's set up, they're not allowed to participate in the export markets unless they're permissioned to do so. And that's a big part of their problem.
Yeah. So cattle market ended higher today, and that kind of continues the higher weekly closes that we saw last week, despite some steady to lower cash trade. So is it just that the demand side is strong? Boxes have been strong. Is that what's driving this or not?
Well, boxes going from 300 to 315 at a time of the year when I think a lot of folks are betting on 280. I mean, I'm one of them. A lot of the analysts I read were, hey, we tap for the summer, and then all of a sudden, I don't know what it was. It kind of correlated with some beef bans in Brazil, in Argentina, but I don't think that's a player. All of a sudden, the box beef started to rally, and now the packing margins are back in the green again. It was a huge week last week for the Packers, and I expect them to chase it with live here, at least as much as they're willing. And the feeder markets are the ones to watch. And today we had a breakout, and it came in a day where grains were higher, corn was higher. So all in all, I think that I'm a risk manager, so I'm going to say, hey, you're a cow calf guy, you can lock in 230 on a $2 break even. I think that's a no brainer to do. But if beef's going to trade 315, then we can trade $300 feeders. We can trade $200 live. I don't think it'll stay there, but I do think those deferred contracts, specifically like April of 24, keep an eye on that. And then lastly, we follow the crush here. And the crush margins, especially in the front of the curve, are really strong. So it's kind of a come bet I think a lot of these producers are making, or at least the feedlot guys are making here, thinking, hey, we can afford feeder cattle, we got to get in front of it. And I've seen pretty active buyers here on the board in the last couple of weeks.
Yeah. Hogs done going down here. Have we found some support finally?
Well, the folks who I know probably watch this, they're hoping for mid to high 70s. That's the December targets that we'd have in. Above that, I think a lot of it depends on what corn does. Break evens have come off substantially, but the packing margins are okay. And you had a carcass price that is hanging in, and in reality looks cheap relative to where beef is. So I think at this point in time, I'm hopeful. I would be remiss to be looking at December in the mid to high 70s and pass that up. I'd rather be wrong on Dece and be right, not hedged on the Feb or the April. But all in all, at this point, I think we're more of a sideways trade. The Prop 12 news that was kind of baked in there a few months ago, that seems to have kind of abided. And I think the industry in a way has taken it with stride. The producers I know, they were kind of crying ahead of it, but now I've realized a lot of them were prepared for it. So, they're now entering a new business environment where they kind of can participate in those markets. So it'll be a good time, I think, for the industry here over the next couple of weeks. If we can see feed prices kind of come off and stay off, that's really, I think, the key there.
Thanks for joining us, John Payne, Hedge Point Global Markets. That's Markets Now.